Today, I'm going to talk about quantitative methods that we will be using in risk management. I'm going to start developing the concept of portfolio return. I'm going to do quantitative methods in the context of investments, not just for the sake of quantitative methods. We went through this yesterday, and now I want to spend a little bit more time on it. Given any asset value, stock, a bond, a fund, share class, a house, a car, you define the return as it's written here. It's the difference between the value today, the value at the previous period, so yesterday, the previous month, the previous year, divided by the previous value. This is a quantity that has financial meaning, but it's also a quantity that has mathematical meaning, and we went through that yesterday during your exercise. This is a differentiation of a time series, which allows us to get rid of zero roots, which gives rise to a universe of statistics that we can do, without which, if you don't do this, the statistics would be wrong. So there are two reasons why this is needed. One is mathematical. The results that we get when we do this for typical prices in typical markets will give us something close to independent, identically distributed variables. And if you don't do that, we're going to find ourselves in situations where a lot of the methods that we'll describe today will not work. So we need to do that mathematically and financially. Now, there's two ways to differentiate a series, and the other one is by taking logarithmic returns. And that also came up yesterday when you were doing the time series. A lot of what I'll do today came up yesterday. And maybe some of what we'll do this afternoon will come up tomorrow. The idea is you have to go first. This has the same effect. In fact, by Taylor's theorem, if you expand the logarithm by Taylor's theorem, you will get that the log return and the return are close to each other, very close to each other, when the return is a small number. But they would be different when the return is not a small number, and it gives us two ways of looking at. They have their own benefits, each of them. I'm not going to spend time discussing that just yet. In either way, this gives us a way to collect a time series of portfolio returns. 99% of the people in industry would use the simple return, the one on the left. Very few weird mathematicians would use the one on the right. It's your choice. The difference is not major. Now, we already dealt with that. Today, my perspective is going to be to how to use these numbers to do portfolio statistics. And there's going to be two objects that we're going to be working with when we do portfolio statistics. Indirectly, we're going to assume that this time series we have is going to be independent and identically distributed, indirectly. Okay? They don't have to be. The definitions that I will work with will not need them to be independent and identically distributed, but a lot of the background mathematics will make that assumption. So the first is this. I'm going to look at the portfolio cumulative distribution function defined as the probability given a benchmark x. I look at the probability that the return is less than or equal to x. That assumes that the probability is the same for all observations all the time. It assumes that the distribution that I have today will be the same as I had yesterday or the day before. Implicitly, it's assuming that. And if that's not the case, then it's not clear how to calculate that probability. But if it is the same, then we know how to do that. I just take my historical series and I use it to calculate that. I can do that by counting. And that's the cumulative distribution function, CDF. It's a function that grows from 0 to 1. it measures the following. If I say that f of a certain point is 25%, that means that the probability that my returns are less than that value is 25%. And the objects on the y-axis are called the quantiles. And you know that. You probably also know that there's a fundamental object in financial risk management, which is called value at risk, that was introduced in the banks in 1998, which is exactly this definition. So this is something which is fairly ubiquitous. It comes up very often. And the reason that quantiles are very natural mathematical objects, so we will encounter them all the time. Now, with that comes a very close relative of the cumulative return distribution function, the portfolio density or the return density. They're both related by a formula. One is the derivative of the other, or one is the antiderivative of the other. If you have one, you have the other. Most people work with the yellow curve, with the return density, because that's what Excel gives you. Again, back to Excel. Excel is a very big driver for the quantitative methods people use. If it's not in Excel, people will tend not to use it. For many applications, the cumulative distribution function is what will be more interesting for us. But we don't care because we are polyglots. We understand both yellow and green. And we know that they are really the same thing. One is the derivative of the other. Now, with that in mind, I will make a few remarks about the statistics that we can do with the return. First, with the return. I'm going to talk about portfolio statistics. I'm going to focus on two, the return and the standard deviation. Of course, I know you know that, and we went through that yesterday and this and that, but I need to make a few comments, which I think are important. The first is this formula here. Many people think that this formula is the definition of portfolio return. And this is calculated by looking at the return numbers on a, say, each period, daily, monthly, and then you sum them up and you divide by the number of them. All right? And some people think this is the definition of the volatility or the standard deviation of the portfolio, where you take the same monthly returns and you just square them, divide by this and that. The reality is that neither of this is the definition. The definition is this one. What we have on the right are the estimators, and what we have on the left are the definitions. That's an important distinction. And that's what I want you to understand. It's very, for some of you who know a lot of math, this you will be clear, but for some of you, this may, I may be very pedantic, I may sound very pedantic, but I'm not. There's something very important to understand here, and it'll become very clear towards the end of this morning. The thing on the right is the estimator to the thing on the left. They live on different worlds. The thing on the left is the mathematical definition. I use the portfolio density, I multiply by X, and I integrate that. Or I take the expectation of their return as a random variable. That's the definition, and it's on the left. And that lives in the world of ideas. This is what people in probability do. And same thing for the standard deviation. You have the definition on the left. What I have on the right is the estimator. Statisticians will tell us that if you want to understand the thing on the left, you have to do the thing on the right with the numbers that you have in your sample. Probabilists will not care about the things on the right. Expressed differently, the thing on the left lives on heaven. The thing on the right lives on earth. Are you familiar with Platonic philosophy? Plato, Platon, are you familiar? The world of ideas and the world of shadows and this and that. Okay, so the thing in blue is the world of ideas in Platonic philosophy. Something that exists, but we cannot see. We can only see the shadows. The shadows is what's on the right. The advantage of the shadows is that they live on planet Earth, and I can put them into Excel. But they're wrong. You expect that they look like the things on the left, which are the right ones, but they live in heaven. We don't see them. We still think of them, and mathematics lives in heaven too. And that's why they get along so well. Do you know this? Yeah, I guess you know. I don't know how to say it in German. On earth as it is in heaven. You heard that? Yes, you have. Yes, you have. Someone translate that into German, please. On earth as it is in heaven. On earth as it is in heaven. This is the ideal, that things on earth are as they are in heaven. The Lord's Prayer. How do you say that? Anybody here is a Catholic? No? The Lord's Prayer.
What?
I mean, I'm not in the church anymore, but I did all the things that a good Catholic needs to do.
So you know what I'm talking. So you know what I'm talking about, yeah?
More or less.
Shall I look it up?
As you like.
This is the philosophy for today. Things on earth should be as they are in heaven. There you go. All right. It's now clear. So that's going to be our rule for today. The thing on the right is what I can put in Excel. It's on earth, it's dirty. The thing on the left lives in heaven, is clean, is beautiful, but we don't see it. Mathematicians are very happy living in heaven. They hate going to earth, getting dirty and working with Excel. Why would you do that when you can work in heaven with beautiful blue objects, right? Understand? But we have to manage real money. So heaven can be very useful to develop ideas, but at the end of the day, we need to know what we're doing. So we need to do something. We know what we're doing looking at heaven, but we have to do something, and we do that in Excel. So the good thing is that the thing on the right is related to the thing on the left through theorems that tell us about convergence and robustness and things like that. They're, bias and all of that. And that's where a lot of statistics is to try to understand what's in heaven through things you have on earth. Would you say? It's very important that we have that, because as we will see later today, there will be a few examples that practitioners use in investments that have no analogy in heaven, and therefore they're wrong. I told you that mathematics is going to be very useful to us as a nonsense detector. And one of the things we're going to apply is when someone gives me a formula that is in Excel, you immediately need to think, okay, how does this look in heaven? If it's similar and there's a theorem that says it's the same, then you're good. But if there's nothing like that in heaven, be very suspicious. Okay? That's going to be the starting point as a nonsense detector. Heaven and earth. Good. But there's more. We have to be very careful with the statistics, and we already saw this example yesterday. I'm going to go through that again. If I have a fund that produces a, no, I'm actually not sure we saw this yesterday. Okay, so imagine I have a fund, I start a fund and I put $1, and I'm very successful, I buy Bitcoin, and then I get another dollar. I got two. And then the next month, I lose the $1 I made. And then I make it again, and I lose it. And I make it, and I lose it. That's my fund. So 1 month I make 100%. The next month I lose 50%. See? Continues. Let's do some statistics on this. If I do the statistics that people do, I'm going to get an average return of 25% per month.
Sounds good.
It sounds good. Okay, it sounds good. What if I didn't show you the numbers and I just told you, I have a fund that produces 25% per month on average? Would you invest? You would invest.
Sell this fund to everyone.
Sorry?
I can sell this fund to everyone.
You can sell the fund to everyone. Everyone will buy it. And in fact, I told you yesterday, a lot of the time, I have spent 20 years listening to presentations like this. This is an extreme example, but I hear presentations like this all the time. Someone is trying to sell me a fund, the average return of which is 25%. Yes?
We just have to de-invest in the right moment, then we make 100%.
Sure, good luck. Good luck. Because that requires, you need to have a very good insight as to what's going on in heaven and earth at the same time. Okay? But what's wrong here? Is something wrong? And you're a mathematician, you can see what's written here. Of course, if you look at the logarithmic return, you see that the average is 0. Yes?
The denominators changes all the time for simple returns.
Yeah, so you're explaining to me why, when I do the calculation, I get 25%, right? But that requires perfect knowledge of the data. And these things are used by marketing firms, so they don't have to give you everything that happened in the fund. They just tell you, oh, it's 25%. Oh, per month? Wow, that's 300 per year. My God, this is what you do in Bitcoin. What are you doing? Right? But the reality is that they don't make any money. Told you, mathematics is the ultimate nonsense detector. What's going on in here? Anybody knows? Anybody knows what's going on in here? Determinator. No, but there's something fundamental in heaven. There's something in heaven that gives you an alarm. Heavenly objects are wonderful because they're always right. Earthly objects, you never know. Excel, beautiful chart, but I don't know. Look at the standard deviation. The standard deviation is, I think you see what's going on. The standard deviation is 70%. Have you heard of something called Ito's lemma? Have you heard Ito's lemma? Oh, so you know Ito's lemma. Ito's lemma lives where? In heaven, exactly. Let's bring it down to earth, okay? Can we bring it down to earth and make it work? What would Ito's lemma tell us on earth? How would Ito's lemma give you some insights about what's going on in Excel without having to look at all the data and see what's dividing by what? What would Ito's lemma say? You know Ito's lemma, yes? Everybody knows Ito's lemma?
Heard of it, but could you repeat it?
Hold on. No. I'm not interested in telling you. I'm interested in knowing if you have seen it, if it's been explained to you. Because that's something I cannot explain to you in a short time. I just want to know, has it been explained to you? I'm not asking if you understood. That's not what I'm asking. I'm asking if it was explained to you. It was explained to you. Everybody, you had it explained to you by everybody? Yes, but it didn't. Okay. By the way, I explained Ito's lemma to my students in Toronto yesterday. That's what I had to teach. And this example came up, and I told them, every time I explain Ito's lemma, I show this example. Because this example is a consequence of Ito's lemma. Everybody who knows Ito's lemma is not surprised by this. I'll remind you what Ito's lemma was. Please try to connect it with whatever you remember was explained to you. It says something like this. If I take a certain Ito process and apply a function to it, that's a new Ito process. But the drift changes. The drift is increased. There you go. You can finish that? Do you
Mu plus 1/2 sigma squared dt.
Exactly. So you remember that. Do you remember that? Do you remember that? Please say no if you don't. I need you. Do you remember? You don't remember that. Okay. So Ito's lemma said, do you remember something called an Ito process? Ito. They've been explaining Ito processes to you too. Well, is this an Ito process? I have two Ito processes here. Two. I have two Ito processes. One for the price, which gives me the return, and one for the logarithm of the price that gives me. So I have two Ito processes here. And one is the logarithm of the other. And what Ito's lemma says is that if you take the logarithm of one, what you obtain is another Ito process, but you have to increase the drift by 1/2 sigma squared. Do you remember anything about 1/2 sigma squared? Do you remember that? Okay, that's all I need you to remember. Everybody remember the 1/2 sigma squared? You do? You do? Great. Okay, what is sigma? I know. How much? On Earth. It's actually 70% because it's the logarithm of the, it doesn't matter, 75, 70 or 75. They're very similar. They should be the same. By Ito's lemma, they should be the same. They're close because this is not exactly an Ito process. It's a discretized Ito process. But you see the volatilities are pretty similar, 70 or 70. What is 75 or 70 squared divided by 2? You can do that? Volatility squared divided by 2. What is it? It's 25%. Exactly. That's why I have 25% as the average return for my simple return. Ito's lemma.
But the square of 75% is 0.5625 divided by 2 is 28%.
God, don't be picky. Don't be picky. That's 25%. This is a discretized version, okay? Look, I mean, heaven on earth, they're not going to agree to the exact, 7 decimal places, right? Right? I'm teaching you philosophy. In philosophy, 26.7 and 25 is the same number. I'm teaching you philosophy. I call it quantitative methods, but it's really philosophy. You understand what I'm saying? That's Ito's lemma. 25%. Please. Yes? Yes? By the way, this is a fantastic story for everybody in marketing. You have many different ways of expressing your fund returns. We're going to see more today, by the way. So pick the best, which is the best for you. But if you're on the receiving end, you need to understand what's being sold to you. If you're bored on a Sunday, you have nothing to do, dust off your Ito's lemma explanation and put it side by side with this and find the connection. That's my advice. And then you understand Ito's lemma. You don't understand Ito's lemma until you see this. Guaranteed. I don't care how much math you know. Sophia, you agree with me? You have to know this, and then you understand Ito's lemma. Anyway, so this is what is going on. It's a very good example of another thing we need to understand. we have to be very careful with the statistics. Statistics and accounting, terrible enemies. They don't understand each other. Accountants do not understand statistics, and statisticians do not understand accounting. And by the way, you have to understand both. We already saw yesterday how important accounting was, right? You were the accountant, you were the CFO. You were the CFO, right? You see, very important. And you're a good statistician too, I can tell from here. You have to do both. In this business, asset management, you have to be both a statistician and accountant. And it's very hard because they tend to be in a constant class. This is not the only example, we're going to see more. Okay, this is something which you, yes.
But just the slide before, now tell us that we always should use the logarithm and never, like the other return is just false? Or
So which slide are we talking about? This one?
no.
The next one?
Table,
Yeah.
yeah, two different returns. The simple returns.
This one?
No, the table.
This one?
Yeah.
No. No, you can choose whatever you want. Just know which one you're using and what it means. Okay? So no one says that an average return of 25% means you make money. Well, no one here. You go there, I don't know what people think, you know, people believe anything these days. So the only thing I'm saying is that you can see here that an average return of 25% does not mean that you make money. Then use whatever whatever method you want. Just know what it is that you're doing.
So you mean this average return of 25% comes from that drift, that it goes a little bit.
Yes. So, okay, we're going to see more examples like this, but let me spend some more time on this. Imagine, I have been in this position many times. Imagine someone is trying to sell me, Jan here is trying to sell me a fund. And he took this course at TUM, was a fantastic course, where they talk about how you can use Ito's lemma to increase your sales. Okay? All right. And I'm there, and he's telling me, oh, I have a fund. And this has happened, by the way. The last example of the day is the best, but we'll have to wait a couple hours for that. So you tell me you have a fantastic fund that has a average return of 25%. Am I interested? So, well, yes, I'm interested. And then I always ask the same question, what's the volatility? The volatility, you tell me, oh, volatility is very high. But sometimes, we double the money so often that, yeah, that's why the volatility is very high, because sometimes we make so much money. And volatility does not discriminate between losses and gains. It's all part of the same story. And then I say, yes, but what's the volatility? And then you say, oh, it's 75%. Then I do a quick calculation in my head. I say 75%, 56 divided by 225. Okay. And your return is 25? Yes. Okay. I know you're not making money. And then you say, how do you know? I said, because I know. There's nothing wrong in what you said, but some people will be led to believe that if the average return is positive or even high, then you're going to make money. No. If the average logarithmic return is positive, then you will probably make money. Yes.
But only probably? It's not guaranteed?
No, not even. No. I can come up with a weird sequence of numbers.
I'm just thinking about it, like when they calculate the risk return trade-offs usually, do they just, for example, calculate a return on an annual basis and then use the standard deviation throughout the year, or do they also use the average return? Because when they would use the average return, I would say, okay, then it makes sense that that's not necessarily a proof that more risk means more return, right?
Yeah, so I cannot answer the question because you say when they do, I don't know what they do. But I can tell you that in the investment sector, people do all sorts of things. Half of the time they don't know what they're doing, and the other half of the time they're doing it because it serves their own interests.
But for example, in academia, this phenomenon is
Oh.
well known, and they
Well. Okay, so in academia, this phenomenon is well known. Actually, let me say one thing. This phenomenon is well known, but very few people understand it. Do you understand what I'm saying? Yeah. I have met people who knew no math in the investment sector, that you will not fool them with something like this. And they didn't know any math. But they know that if you lose half the money, you need to have twice the return to make it back. Because they've been there, right? And it's not that I'm now praising that math ignorance is good. I'm not saying that. What I'm saying is you should have both. And that's what I want you to gain in this course. I want you to have the strengths of mathematics as a method to calculate, as a method to detect nonsense, but also I want you to have the common sense and the intuition that will prevent you from making mistakes. The people that I know in finance who would not fall for something like this are the people who have great intuition. They have probably never done any calculation. Sometimes they don't even use Excel. Warren Buffett. You go to Warren Buffett and say, I have a fund that has an average return of 25%, he will not believe anything you say. He doesn't know about Ito's lemma, he cannot explain anything to you, but he will just not believe you. This is not a statement against math, no. But it's a statement that says, if you're going to use math, you have to be very careful. And always look at heavens. And make sure that what you have on earth is what you have in heaven. And in this case, for example, the lens of Ito's lemma is fundamental to understand the numbers that you have here. Because people make a mistake. The numbers they have here, they think they correspond to a different object in heaven. They didn't realize that the logarithmic return is the one that really gives you the drift. And the simple return has an extra drift, which is sigma squared divided by 2. And that's knowledge of the heavens. You need both. There's going to be more. This is, don't be too, how can I say, hung up on this. There's going to be more examples, okay? We're going to see a lot more of these things. And then every one of them will require some thinking, some. So I'm going to, here's a question for you. You're going to do something similar to this today. By the way, I think it's mentioned on my website, you have to, did you register for this website, hfr.com? No? Not yet. But were you notified to register? No. Sorry? Yes, it's in my website. Yes. Okay. So you did? Great. Okay, perfect.
We can download everything without registering.
Just register. Sometimes it takes, how long did it take for you to get registered? Oh, 2 hours. Okay, same day. Good. Okay, so yeah, I need you to register because this is a website. It's hard to get data of certain objects. And these objects that they have there, which I'll explain later today in the afternoon, I need you to download the data from that website, but they cannot give you the data until you register. This is for regulatory reasons. It's hedge fund data. And in the United States, hedge fund data is considered to be, it's worse than porn, okay? They don't want people to have hedge fund data because they're very afraid that people will be tricked into some weird investment. And that's exactly why you need to register. They need, on the one hand, they need to execute certain processes. Also, and by doing that, they remove the liabilities that then if you invest, that's your problem because the question they ask you is precisely so that they are not on the hook for any liabilities. If now you invest, then you lose money, okay? But that's what In the United States, it's illegal to have that data open to the public. And it's not enough that it's password protected. No, you need to tell them who you are, why you need it, and this and that, and then send a disclaimer that said, if I invest, it's my own business, and this and that. Okay, so this data is from there, and it's this data which we're going to use because it has some very interesting characteristics, and that's why I want you to register and get the data. What I have here is the evolution of some of those hedge fund indices, which I don't need to tell you now where they are. And this is the evolution of the mean return. So the mean return follows these paths that we have here. I mentioned earlier that in our definition of mean return, or in the definition of the cumulative distribution function, I'm making an implicit assumption, which is that the probability is IID. Does this look like IID to you? It is not IID. This does not look IID, not at all, okay? Here what I'm doing is I'm taking a 2-year window, I'm calculating the average return of a whole bunch of indices, and then I move that window one day into the future. So this does not look like IID. Does this, that gives a conflict. Does this look IID to you? This is the standard deviation. Does this look IID to you? It does not look IID to you. No, it does not look IID to me either. In fact, let me ask you, what is this? There's that, have you read the book, The Little Prince? Saint-Exupéry? You have? And in the first page, what? Okay, read it again. It's a great book. It starts with a picture like that, and the boy is wondering whether it has something like that shape. The boy is wondering whether that is a snake that ate the elephant or a hat. You haven't read the book. You have read the book. May you remember that. I recommend the book. It's a great book. Saint-Exupéry, beautiful book. So why do we have that? What is this? This is the volatility, the standard deviation of a whole bunch of indices, and for 2 years there's a plateau there. By the way, people in industry, they do this all the time. They take a 2-year window, they move it, and what are the conclusions? So this looks like a 2-year period with a lot of volatility, right? Yeah. Is it? Is it a 2-year window with a lot of volatility? No. Something happened in 2008 that was so big that it affects the statistics for 2 years. Why? Because I have a 2-year window. And after 2 years, whatever happened on that day, it disappears from the sample. So this is a numerical artifact. There's no statistics here. Do you understand what I'm saying? This is a numerical artifact. If you had taken a 3-year window as opposed to a 2-year window, it looks like that period of high volatility lasts 3 years. No, you made the decision how long it's going to last. And this throws people into misunderstanding everything. Another example of things to avoid. That was the financial crisis of 2009. It was so big that it changes the statistics of everything. I told you that when I was lecturing here in 2009 and 10, I had to ask people to remove Volkswagen from the DAX index. Why? Because of one thing that happened on October 2008. So big, it changes the statistics. So the statistics that we have seen earlier, they behave in an extreme way with respect to outliers. And outliers, Excel does not warn you about an outlier. ChatGPT may, but Excel is not going to warn you about outliers. So careful. Did you notice that there's a number of your time series which is 1,000 times the size of the others? It looks suspicious to me. ChatGPT may tell you that. Excel not just gives you the number. There's no warning. And the result that you get is wrong. Okay, so it looks like my lecture is a bit iconoclastic. I'm trying to destroy everything that you may have been told. Yes? Well, that's part of my objective. Yes, I want you to doubt everything you know. because the relationship between heaven and earth is very tricky. Very tricky. Okay? 2 years later, this thing goes away because the human decided to take a 2-year window and forgot. Okay, I have I will say a few things about machine learning today. This is my first. If I take the same observations that we had earlier, but I organize them differently, just every day I put the mean and the standard deviation, neither of which seem to have any meaning, and I put them into this scattergram, what do we get? We get something that suddenly has a lot of meaning. I can see 3 types of investments, one with higher risk, one with medium risk, and one with lower risk. And there seems to be no question about that. It seems that this is correct. Right? What did I do? I just looked at the graph in a different way. I removed the time dependence that really has no meaning. And I just saw how these 2 features, return and standard deviation, are related to each other, and I see that they have some relationship. Okay, so we're going to see about regression trees later today, hopefully, and this is going to be something that we will do all the time. So, good. Okay, let me now move to another set of examples. How do investors calculate return over time? The standard way, what everybody does, is to calculate what's called the time-weighted rate of return. What you do is you have certain returns. Oops, what happened there? You have certain returns over time, and you compound them by just the typical return compounding, which is you just compound the monthly returns. Yes? That's how everybody does it. Great. Let me go to this example. I have another fund. I'm an investor, so I start with $1 like before. Let's just look at the fund balance column for now, okay? Then I make $1 to 2, but I don't lose it. In fact, I double it again. And the next month I double it too. And then I double it again. And I keep on doubling. You see what's going on, right? I double. My God, I have $256 by September, $512 by October. In November, I have $1,024. So I'm so good. I don't even need a salesperson for this, right? So I get a call from my friend Elon Musk and says, wow, you're good. Yes. I say, how about I give you $1 billion? Go ahead, give me $1 billion. That month I lose half of it. Picture that? Good. Let's look at the statistics of that. What's my cumulative return? You have it on the far right column, right? It's 100, 300, 700, 1,500%. By November, I have 204,000% return, cumulative. But the last month I lose half of it. What's my cumulative return? It's 102,000%. I get the Manager of the Year award. No one beats my return, 102,000%. But I've lost $500 million. Right? Another example why statistics and accounting don't really go together. Of course, I know what's going on. You know what's going on. My great returns come when I have very little money. And my one bad return is when I have a lot of money. The statistics don't care, because the statistics I just showed you is just the compounding of the return, and the return is agnostic to how much money you're managing. It's relative to the amount of money you're managing. And whether you take logarithmic returns or it doesn't matter. Yes? So this is another way you can use this to attract investors and hide the truth. Now, because of that, so there's some other columns here. One column is the P&L. The P&L tells me how much money I'm making. $2, 4, 8, and then I'm losing $500 million. That's the P&L, the profit and loss. I have the monthly return, which I need to calculate my cumulative return. And then I have the inflows, which is how much money goes into the fund. I have a fund that, so there's an inflow in January and there's another inflow in December, $1 billion, and nothing else, right? So there's another way of calculating, so the time-weighted rate of return is 102,000%, but there's another way of calculating the returns over time, which is what's called the internal rate of return. In the internal rate of return, what I do is something different. What I do is I look at the cash flows into my fund, which are two, $1 in January and $1 billion in December. And I look at the final value of my fund, which is 500 million. Yes? By the way, this is the same formula you use for valuing bonds. It's called the yield to maturity of a bond. It's not the yield, not the spot rate. It's the yield of the bond, the yield curve, which is useless, but it's the one that is used to calculate the yield of the bond. You have seen it before. So it's useless for bonds, by the way. It should not be used for bonds. It's very misleading, but this is not a course in fixed income. So never use that for bonds. Use it for funds. Very useful for funds. Because when you do that here, I have two cash flows, $1 in January and $1 billion in November. So you calculate the implied return because it has to satisfy this expression, and you get that the return is about minus 50%, which is what it intuitively should be, right? It's terrible for a bond. Don't use it for a bond. Use it for a fund. But how do you know all these things? There's only one way to know all these things. You need to have experience. You need to have seen these things. And if you just follow the academic discourse of definition, I use this, and then you will never know these things. Okay. All right, let me continue. There is one calculation which is very hard in investments, and that is to calculate what's called market timing alpha. I am not going to tell you why it's called market timing alpha, but market timing alpha is a property that certain investors have, which is what you mentioned earlier. They seem to know when you go into the market and when you leave the market. So your value comes not from the investments that you have, but from your ability to get into an investment at the right time and exit at the right time. I think someone mentioned that. Ole, I think, mentioned that earlier when I was doing the 1-2-1-2-1-2 fund, right? Did you mention that? Well, if you have that ability, which is extremely hard, I know very few people who have it, that would be called market timing alpha. And I have an example here of two managers. One is active, one is passive. I want to explain to you the difference between active and passive management. The first example I have is a passive manager. Invest $100 in a certain security, and the security goes up, then down, then up, then down. At the end of the period, but does nothing, just invests and goes on vacation. And then comes back after 6 months and said, oh, look, I made 25% return. But by the way, I didn't make any money. So this blends some of the other things that we had earlier, right? To say, well, wait a minute, what's the volatility of that? I'm pretty sure the volatility of that is like 50%. Or maybe 70%. Because you didn't make any money, so it was my gain. But I'm less concerned with that now, because I have this other manager that invests in exactly the same security, has the exact same monthly return on average, but this manager, as you can see, does not go on vacation, invests $100. When then the stock goes up in value, that goes down in value, And it's very high up, it takes the money out. And then it puts the money back in when it's very cheap. He will have exactly the same return as the other guy. Because again, the return does not take into account how much money you have, right? The return is the same, 25%. But he's making $150. At the end of the day, he's making 250% return. And all he did is come in and out of the fund, or come in and out of the asset or the stock, whatever it is, at the right time. Yes? So I have the statistics of both of those managers. The passive manager has a time-weighted rate of return of 0, has an IRR of 0, has an average rate of return of 25%, an annualized rate of return of 300%, and an annualized rate of return with compounded of 1,355%, makes nothing. The other one has a 10-weighted return of 0, has an IRR of 13.75%, because IRR does take into account how much money you have. Has an average rate of return of 25%, same as the passive guy. Annualized rate of return, the same, 300%, because it doesn't take into account how much money you have. And the annualized IRR, also the same, because it doesn't take into account how much money you have. Of all of these metrics, only one takes into account how much money you have. And that's the IRR. Right? So one of the things that, this is my proposal, I didn't write a paper on this, but the market timing alpha, for me, it's a way to look at the difference between your IRR and your time-weighted return. And it gives you that ability to understand whether a manager has that skill. Okay? Okay, great. Now, that does it for... Shall we take a break? It's up to you. Or I'll continue. Now, let me do one more thing. Two more things, and then we'll take a break. So, everything we have said so far deals with individual funds. Let me talk about relationships now. The relationships between funds are very important. We already saw that yesterday when we saw the 100 swaps that we had. And the covariance is, you probably know this, it has a heavenly definition, which is the product of that, and then it has an earthly definition, the one that you have in Excel. Right? You've seen that, I know you've seen that. And then I have the correlation, which is the variance divided by, the covariance divided by the product of the standard deviations. And the Cauchy-Schwarz inequality says that the correlation will always be between -1 and 1. In other words, the correlation has no units. So yesterday you did your covariance analysis with eigenvalues and eigenvectors, and we went through that. I'm going to see some more about that today. But one thing I did not ask you to do, and I would encourage you, you don't have to if you don't want to, we're not going to do this afternoon. I encourage you to do the same thing, not for the variance, covariance matrix, but for the correlation matrix. Huh? The correlation matrix has advantages, which is that it doesn't have units. So for example, if some stock there is very heavy in the returns, very volatile, then when you look at the correlation matrix, the behavior is going to be different, and the factors will be different, and the weight of the factors will be different. And it's interesting to compare the two. Okay? But that's something that it did not come up in our discussion yesterday, but I'm telling you now that if you do the same analysis you did with the correlation matrix, not with the covariance matrix, you will probably get something different. And if you get something different, there's meaning in that difference too. I'm trying to develop your intuition between all these things. Great. So the covariance matrix has this interesting property that you have seen this, I am sure. There's many ways of saying this. If I have assets that I allocate to, I allocate an amount which is WI, that's the wealth I put into asset I, and the assets have a price which is given by a random variable x, then my portfolio will have a volatility which is calculated here. The volatility is the expectation of my random variable times itself. I work out the product and I expand the sum, and what I have is the cross product between the weights I allocate to each asset and the covariance between those assets, which can be very conveniently written as a matrix multiplication between the covariance matrix and the weight vectors, to the right and to the left. In the right is the transpose, so the matrix multiplication makes sense. You've seen that. Maybe you've seen that in the context of what's the standard. You may have seen that in the context of a linear combination of Gaussian random variables is a Gaussian random variable, and it has a variance covariance matrix given by that. You may have seen it like that too. Well, either way, this gives us the portfolio volatility as a function of the weights and the variance. And from there we observe how here we get something that we used yesterday. If my variance covariance matrix is diagonal, my correlations are 0, then all the off-diagonal terms drop. And that's why I said yesterday that my portfolio of 100 swaps has a standard deviation which is 1/10 of the volatility of an individual swap. With this, I could do something which is a little bit more general, and if the correlation between the swaps is not 0, it's some other number, the portfolio volatility of my Snow fund will be another number. Not 5% as it was, maybe a different number, but it comes from this multiplication. So I could use this in situations where I put together a portfolio and the assets have some degree of correlation. That is the resulting volatility. So this is related to what we did yesterday. You do realize that, yes? Huh? Okay. So this has an interpretation, and that's that volatility of a portfolio decreases if the correlations are less than 1. And this is a very important property. Markovits, who is the one who played with this a lot, and whose name we're going to be mentioning now, he said that in finance there's only one free lunch left, and that's diversification. Diversification is the only thing that makes you money for free. Because for Markovits, if you decrease risk, it's the same as increasing return. The relationship between the two is very clear. Okay? And that's what we have. So we're going to take a break now because I want to now tell you about Markovits, what he did in 1952. And for that, I need you to, maybe even I should have a coffee, because we're going to need to have a lot of energy for this. Okay? And I'm going to hire 2 people as traders. Yes, you're raising your. Why are you raising your hand? You want to be higher, right? And you too, right? Good, you're learning. That's good. Okay, so this course is finally working. Okay, okay. When someone says I'm higher and you raise your hand, exactly. Thank you for that. You made my day. I know this course is working. Okay. We'll talk about that, okay, and see if you like it. See if you like it. I'll tell you the salary later. Let's take a 10-minute break and then we continue. So I want to now shift my attention to portfolio theory. And again, these are things that I think you know, but I want to review them from my perspective to ensure we're all on the same page anyway. So 1952 was an interesting year for portfolio management because a graduate student at Stanford University called Harry Markovits, he was probably before 52, he thought about portfolios in a different way, something that had not developed until then. Before Markovits, the idea of a portfolio was something which was focused on return exclusively. There was no concept of risk, not as we understand now. And because of that, there was also no concept of diversification and some of the things that he somehow either invented or brought to our attention. So he simplified the process of investing by focusing only two numbers, the expected return and the standard deviation around that return. From that perspective, portfolio theory became a choice of a point in a two-dimensional plane. This is a massive exercise in data compression. Everything that that goes with selecting a portfolio with all the considerations is all very complicated. So I just pick two numbers and then I make my decision on two numbers. And I'm sure you've seen this. This is the CAPM curve. If you have investment in stocks and bonds and you go through the different proportions that you can have in stocks and bonds, you see how when you start with the riskiest asset, stocks, and then as you bring in more and more of your percentage wealth into the less or less risky asset, you see that the risk, of course, continues to drop. But there's something interesting that happens, which is, according to this figure, there is a point where the risk is least possible. And if you continue bringing the riskless asset into the portfolio, the risk actually increases, goes up. So the portfolio is efficient only up until that point. When you increase your investment in the riskless asset, your portfolio risk actually goes up. Why? Because the effect of diversification. Diversification ceases to give you that risk reduction and actually risk increases. That's his perspective, right? So that point is the optimal point from a risk minimization perspective. And that is a very interesting perspective. More generally, if you consider all of your decisions to be points on a plane, the plane is going to contain two regions, the region of possible investments and the region of impossible investments. Numbers which are just too good to be true. They're not true. And Markovich then argues that a rational investor would like to invest, of course, in the possible investments. You cannot invest in the impossible investments, but the rational investor will have to invest on the boundary between those two sets. Why? Because investing in the interior of the possible investments give you a suboptimal decision. You can always make your investment better by going towards the coast. So the optimal investment will always be on the coast, as we all know. That's why beachfront properties are so expensive, right? All right. So that is where you want to invest. And he left it at that. And this is a great perspective. It's been attacked, especially since the year 2000 or so, because there's a very interesting alignment of developments that went with Markovich. Markovich became famous not because he said this, but because he said this at a time when this could be implemented. Computers were created at the same time as he said this. Without computers, all of this would have been a very nice theory, living in heaven without an earthly component. But he said it at a time when computers made it possible to be implemented. So for a lot of years, he enjoyed great reputation because this actually did change the process of investing. But by the year 2000, everybody had their own laptop on their desk. Everybody had their own model, and then people started to see that they could do better than this. Or people could start to see some of the flaws or imperfections in these theories. Then suddenly Markovich became an object of hatred and which is unfair, but that actually developed. Okay, it was the democratization of computers worked very much against these theories, but it worked against these theories because people didn't understand what these theories were. These theories were never meant to be a recipe as to how you invest. It's just a perspective as we have seen before, you like the return. You don't attack the return and say, I should never use the expected return because it comes up with these wrong statements. No, it's a perspective. And this is the thing. Perspectives matter. And talking about perspectives, I want to focus on the one which I found to be most interesting for me personally. There's a very interesting personal story about this for me, which is the Sharpe ratio. I understood the Sharpe ratio. So I understood Markowitz theory very well when I studied that, and I saw it was just a framework. But then Markowitz does not tell you where on the efficient frontier you need to invest. It just says that you invest on the coast, and that's it. Then Sharpe tells you exactly where you should invest. You invest in the place that maximizes a certain ratio between two numbers, mu divided by sigma. It's not important right now. We saw this number yesterday. It's not a surprise. I know you know it. But the first time and this is my personal statement to you, personal confession, the first time I saw the Sharpe ratio, I didn't understand it. I didn't understand why you would divide mu by sigma. I had read all the literature and I saw that this is what people call the unit of return per unit of risk, which didn't make sense to me because risk could be anything, right? And the reason it didn't make sense to me, and more strongly than all the other things, is that when you divide mu by sigma, you're doing something unusual. You're dividing a quantity by another that has different units. I understand dividing dollars by dollars. I understand. You get a percentage. I understand that. But return is dollars per time, and standard deviation is dollars per square root of time. So what you get is a number that it's not dimensionless, it has dimension. So I didn't understand why you would do that. But I went along because that's what academics were doing, and okay. And I finally understood the Sharpe ratio when I created my investment company. And that's because I started to see how people get paid. And I want to tell you the Sharpe ratio from the perspective of the money that you get paid. So I want to hire two people. Okay, I already know who they are. Yu Ching, you're one. Okay, and who else was going to be? You? Okay, Yan? Okay, good. So now you have a choice to make. Okay, maybe I'll hire Yu Ching for the first job and I'll hire you for the second job. Why not? So the first job is this. I'm going to hire, the job is yours, I hired you, okay? And I'm going to give you some money to manage. Some money, I'm going to say $1 billion, okay? And I will give you a very, very small fixed salary, 150,000 euros per year. That's it, okay? I know that you're expecting more, I know, that's okay. But I will tell you that if you make 5%, or some benchmark, I call it R, if you make 5%, I give you $1 million. This is how many people get paid in the industry. They give you next to nothing, but if you meet your benchmark, I get you a bonus, very healthy bonus, $1 million. Would you take it?
Yes.
Thank you. Good. Oof. Okay, I don't have to negotiate further. Okay. So let's all think like Yu Ching, how you would work, right? So you're hired, you go to work, say tomorrow morning. We already know what time you go to work, right? What time do you go to work? 6:30. There you go. Perfect. So you go there at 6:30, you have your coffee. By 7 a.m., you are at your desk, right? What do you do? What do you do?
Go through the market news.
Yeah. But yeah, you read market news, but why? I mean, you be more explained. What do you care for? What are you thinking every day when you go to work? What are you thinking?
So basically, I would try to beat the benchmark, and at first, I would probably just do the investments that I'm really convinced of. But as time goes by, then maybe I realize, hey, I beat the benchmark, then I would be more conservative. If I don't beat it, then I would take on much more risk in order to just beat it.
Okay. So let me paraphrase what you're telling me. All you care is about the benchmark. In fact, let me paraphrase further. all you're thinking is about $1 million. Am I right?
That's good.
Look, if the contract that I gave you is that, it's because I want you to think about $1 million only. That's why I pay you that. Right? Okay, so let me help you a little bit. Let me mathematize what you should do. So I'm going to think like a mathematician. Your objective is the $1 million, but you cannot get to the $1 million until you have a portfolio. And we don't know what the portfolio is. So we do what mathematicians do when they look for something and they don't know what it is. We give them a name. Typically a name which is a Greek letter. So I call it capital pi. How's that? Do you like that name? Capital pi. So the portfolio you're looking for is called capital pi. I know now you need to find it. Like do whatever it takes, just find it. Your objective is to find a capital pi portfolio that maximizes the probability that it beats the benchmark. So it's 7 in the morning, and say, well, I have to find this portfolio. I gotta go for it. And you write that down, and then you realize that could be hard because you don't know the portfolio. But the portfolio must have a certain mean and a certain standard deviation that you also don't know. So you also give them Greek letters as names, mu and sigma. And then you realize that if the portfolio meets the benchmark, the portfolio minus its mean divided by its standard deviation will have to be bigger than 5% minus mu divided by sigma. And now it's the first day at work, so you make a very big assumption. Maybe in the second month you change the assumption, but the first day you make an assumption. What if my portfolio is distributed like a Gaussian? What if my portfolio is a Gaussian portfolio? If my portfolio is a Gaussian portfolio, pi minus mu divided by sigma is a Gaussian random variable. So this expression here is independent of my portfolio. It only depends on mu and sigma. And furthermore, if the probability that a Gaussian is bigger than a certain number is your objective, well, that probability is given by the cumulative distribution function of the Gaussian, the green curve applied to the Gaussian that we saw earlier. For the first day at work is not bad. Markets have not opened, and you already have a pretty good idea that what you want to do is you need to maximize that number. Maximizing that number maximizes the probability that you meet the benchmark. That number is what's inside of the cumulative of the Gaussian with a negative sign. So if you want to maximize 1 minus phi of something, you want to minimize phi, you want to minimize what's inside, or you want to maximize what's inside with a negative sign. You want to maximize mu minus r divided by sigma. See that?
What does mu stand for in this case?
Mu is the mean of the portfolio that you don't know. I remind you how this works, right? You're looking for a portfolio, you don't know what it is. You call it capital pi. Capital pi has a certain mean and standard deviation. Yet you also don't know. You call them mu and sigma. But by introducing mu and sigma, making the assumption your portfolio is Gaussian, makes the term there disappear. This term disappears. Because that's a Gaussian random variable. You go from here to here. This is the first day at work. You can do better on the second day. But for the first day, it's not bad. And then your conclusion, just before market opens, is that, oh, I know what I need to do. I need to maximize mu minus r minus 5% divided by sigma. Excuse me. That's what you need to do. Because that's what I'm paying you to do. Then the second day, you'll do something better. And the third day. But for the first day, this is what you do, right? That's the Sharpe ratio. So when I saw this and I saw how people get paid, I said, well, that's why everybody wants to maximize the Sharpe ratio. Because they are paid to maximize the Sharpe ratio. If I pay you a bonus when you hit a benchmark, and your portfolio is Gaussian, then I'm paying you to maximize the Sharpe ratio. See? Then suddenly all the literature on the Sharpe ratio, for me, became worthless because the Sharpe ratio is in everybody's employment contract. Right? Okay, so I gave you a very good starting point for your $1 million. Now I'm going to hire Jan for another employment contract. I'm going to give you the same amount of money. What did I say, $1 billion? Doesn't matter. But now I'm going to give you, again, $150,000 per year. Sorry, that's your base. But I give you $1 million if you beat a benchmark by, say, 5%. And I'm going to pick a benchmark which is some index, the DAX index, S&P 500, something like that. A major index. What do you do? Again, you go to work at what time?
6:30.
6:30, exactly. You actually have a coffee together. Then she goes to floor number 4, you go to floor number 7, something, right? She goes to get her portfolio, now you go for your portfolio. So what do you do? The same argument we had with her does not work. Yes, so she already knows. So what? No, hold on. No, hold on. No, the story will not end just with this, okay? And there will be many, many days at work. Don't worry. We're only going through the first day. Then we'll think of the second day and the third day and the fourth day. So the same argument we had earlier does not work because now your benchmark is not a number. It's another random variable. So I spell out what your benchmark is as a random variable, I'll call it Y, plus your benchmark, which is 5%. And what I do is the same thing I did with her, but I move you see, look at the math, I move the benchmark over to the portfolio side. The benchmark I know, the portfolio I don't, doesn't matter. But I bring all of my random variables together. And then that new random variable called pi minus y will have its mean and its sigma. And I don't know either of them. I still call them a Greek letter, mu and sigma. I put a subindex so we know it's the sigma of pi minus y, which I don't know. But as before, if that difference is Gaussian, which for the first day at work, I can assume that. If that difference is Gaussian, then that cumulative distribution function is independent of the portfolio. It only depends on the parameters mu and sigma, as before. So now you need to optimize a new ratio, which, as she said, is the information ratio. The information ratio is like the Sharpe ratio. As you can see, it's mu or difference of mu's when it's on the numerator, but the denominator is radically different. The denominator is the standard deviation of the difference. And this has important consequences. By the way, people in the mutual fund industry are paid like that. No one in the mutual fund industry is paid like her. Hedge funds are paid like that. And you will understand this in a few minutes. But in the mutual fund industry, you're paid like that. Why? Because as a mutual fund, your objective is to beat a benchmark. The benchmark is that first eigenvalue that everybody is going to have in their portfolio anyway. And that's the index. We went through that yesterday afternoon. Right? The consequence of this is something very funny. Let's say that, I'm exaggerating a little bit. Let's say that the index drops by 5% this month, and you make 5%. You're probably going to be fired. Your information ratio is going to be very low. In fact, you're supposed to stick to the index. You're okay if the index drops by 5% and you're flat, that's great. But if that deviation gets to be very large, it hurts you, okay? So that is called the tracking error. If your tracking error is very high, you'll probably be fired. If the index is down and you're up, and the index is up and you're down, you're fired for sure. So this is not a mutual fund we want, because the probability you beat the benchmark is very low, right? In fact, I continue with my exaggeration. I'm going to optimize your portfolio right here in front of everybody, approximately. This is what I'm going to do. This is on your second day at work. You meet her for coffee again at 6:30 at the Starbucks downstairs, and then you go to work, and then you realize something. You say, why don't I do this? Second day at work. Why don't I do this? I'm going to put all my money into index futures, right? Which costs nothing. And then you meet her for lunch and say, how about you manage my portfolio for me? And if you make 5%, I give you, how much do we pay her?
10% performance bonus.
No, give me dollars, percentage, dollars, how much?
50K.
50K, 50K, okay, well, okay, so he's offering you $50,000 if you meet 5%, and he give you another $1 billion for you to manage. What do you say?
I don't take it.
He doesn't take it. Try again. So third day at work, okay, you take her to lunch again. This time, pick a better lunch, okay? And now, what do you offer her?
150. But
Okay,
that's
okay.
fine.
Yeah, you don't want to go for lunch anymore. You need to settle with him. Give him a counter offer.
Okay, 200K.
How much?
200K.
200K? Take it. It's good.
That's
Take it. Okay. We got a deal. You understand what happened? You understand what happened? If she makes the 5%, he makes his index plus 5%. Because the index futures gives you the index. And she makes you the 5%. You can buy futures without money. You know that.
So you need some money.
I know, please don't, let's not, I mean, okay. Yes, you need a margin. So maybe you don't manage $1 billion, maybe blah, blah, blah. Maybe, yes. So allow me, again, this is still the third day at work, okay? I mean, the fifth day, yeah, you can talk about margin. Let's not talk about margin right now. That is besides the point. That's a minor perturbation to the argument I'm trying to get you to understand. Because I'm going to explain to you how the asset management sector works everywhere, worldwide. And all of them, not just mutual funds, everything. You understand? So you get your index, futures, and she's going to make you hope, 5%. Right? And then you go to your boss and say, look, here's my index plus 5%. Give me the $1 million. And then you give her, how much? 200K? Then you give her 200K. The advantage of that is, there's many advantages here. First of all, I'm hoping you can manage $2 billion of a portfolio, not just one. We saw yesterday that sometimes you can manage one, but maybe not two. We saw an example yesterday where you could manage two, but not four. So that is part of your decision. So we're going to assume it's still the 30 at work. So you're going to say, I can manage 2 billion. That should be no problem. 5, I'm not sure, but 2, yes, I can. Right? So I have to make the assumption that you can still manage $2 billion and give him 5%. That's one. But for you, you signed the deal on, there was the 30 at work? On the 40 at work, you signed the deal, right at breakfast. And they say, bye, and you go on vacation for a year. No? What do you have to do? She's working, and you have nothing to do. No? You understand what I'm saying? So you go on vacation, and she's working for you. But you get bored after a month on vacation. Said, oh, another margarita. I'm sick and tired of margaritas. I don't want another one.
paid like that.
I go back to the office. You go back to the office and you realize, I don't have anything to do. Why don't I go around and get more money for my fund? Which is your specialty, right? You give her a call and said, Eugene, how much money can you manage? And then you say, I can manage another 5 billion. But you have to pay me blah, blah, blah. Yes? And then you go and say, another 5 billion. Great, I have nothing to do. So you go around collecting money and said, I'm going to give you the index plus 5%. Then you collect 5 billion, give it to her. And now you can still go on vacation every once in a while. She cannot go on vacation. But you can still go on vacation every once in a while, right? And how do you make money? A lot of your performance fees are going to her, but the management fee is yours. She didn't ask for a management fee. She's already managing the $1 billion. She already gets 150K. She's happy with that. Congratulations. You have become a mutual fund. And your job is to sell, sell, sell. Someone else will do the management. Congratulations. You have become a hedge fund. You just work. You just manage money. 5%. Why do you need 5%? I don't know. I don't care. I'll just give you 5%. You figure out what your business is. You just give me 5%. And the world works like this. In the asset management world, there's two types of managers. People like you with a cash benchmark, 5%. It's called a cash benchmark. Also called absolute return strategy. Absolute return, 5. Sometimes called hedge funds, but you don't use that name in Germany because they hate you. In Germany, you call yourself liquid alpha because you're an alpha manager. Understand? And your work is hard, but you're in the office, you're just buying and selling, just trading. Your job is different. It's hard too. You have to sell and convince people and take them to lunches and dinners. But that's your job. In the end, she's the one who's managing your money. And of course, the index futures, which have unlimited volume. Understand? So not only we understand the Sharpe ratio, we also understand what the Sharpe ratio does. And it creates the environment for what's called portable alpha. I have hedge funds, I have absolute return strategies. These are all different names. You can have prop desks also, right? But then you have beta managers, and the beta managers are benchmarked against stock indices, bond indices. You can have infrastructure funds, which will be beta. You just want to obtain the regular return of a regular infrastructure fund. Maybe plus a little margin, which makes you better than the competition. In fact, the way this would work in practice is you're probably not asked to be 5% above the benchmark. 1% above the benchmark for you is good enough. Good enough. 5% is good enough. So you can still pay her if she makes 5, but you only need 1. That means that you probably not give her all that money. Now you have, as she mentioned, you have a margin requirement when you do your index futures, so you don't have all of the money available for that, so 20% is good, right? And you want some money there just in case, because she may blow up and poof, that's too much money, right? That's how this thing gets perfected. And that's how the world of asset management works. There's alphas and betas. Why are they called alpha and beta? Because you don't have a benchmark. You only have alpha. And you have a benchmark. It's called beta. So this goes back to linear regression. Linear regression is what makes these terms. I'm going to go away from this. I'm just going to I want to jump over this. No, this is too easy. I want to talk about regression analysis. That I know you already know, but I want to talk about this and market factors, which is, by the way, what you did yesterday in the afternoon. So there are investments which have a market factor that affects their performance, like yours. And the others that are not, like yours. Or like our snow fund. Our snow fund, we made 7.2%, right? On a normal year. We saw that after fees. 7.2%. Index goes up, index goes down, interest rates go up, interest go down. We don't care. 7.2%. Plus the risk-free rate of return. We saw that too, right? So how can we know, or how can we measure the dependence that you have to market factors? Well, regression analysis was made for that. And I know you know regression analysis. But I want to put regression analysis into the proper context now, which is the context of finding your risk factor dependencies. So I have to have a fund here in blue and a risk factor in black. You can see intuitively that the fund shares the risk factor performance in the way, but it gives you some alpha on top of that. You see that, right? And all of that is done through the regression analysis, which you know the formulas for that. And you know about the R squared and the p-values and all of that. I don't have to tell you that. You're good with that? Yes? Regression analysis? All good? Great, okay. The mathematical foundation is this linear expression. That's why her performance is called alpha and yours is called beta. Because you have no betas to anything. You just give me 5%. But you have 5% plus betas, and you are a beta manager. And you know how to calculate this. These betas are calculated with certain formulas coming from systems of equations. And the distance is the squared distance. All good. This is linear regression. Okay, so good. And you can do this in higher dimensions too. Big surprise, you know that. Great. So let me now then take this and move into the generalization of this. And I want to talk about two things before lunch. I want to talk about linear factors and nonlinear factors. Linear factors is what we discussed in the afternoon yesterday. Nonlinear factors is what we use machine learning for. Okay, so I'll start with the linear. The linear is what we can understand, and the nonlinear is what we can calculate. We still don't understand. So I'm going to focus on market factors from a linear perspective. And securities prices, we know that they move as a function of different things. And we want to understand what those factors are. So linear, nonlinear. This is what I announced yesterday I was going to tell you, which is you did the difficult part yesterday, which is understand the risk factors for equities, stocks, difficult. But we started, and you got the main factor, that was the first eigenvector, and we discussed how the Fama-French model gives you other factors, but you found the encoding into orthogonal directions within the stock market. That's what you did yesterday. And you're going to write a wonderful chapter on the structure of the stock market with eigenvalues and eigenvectors, and it's going to be beautiful. Yes? Let me tell you how this would look like for fixed income. It's more difficult for you to do because you don't have the data. If you had the data, it's very easy, but you don't have the data. So I'm going to show you what it is. So I do the fixed income. If you had the data, then you would see, I'll only pick 3 days. Okay, so this is the evolution of the yield curve over time. So I have 3 days. You had how many thousands of days for your stock information? That was like 5 years, right? That's a lot. That's more over 1,000. I have 3. Okay, so if I have 3 time series for the yield curve, I can do the same thing you did yesterday, which looks as follows. This yield curve is going to end up being the superposition of 3 very well-known movements. One is the parallel shift. Everything moves up and down by the same amount. Then you have the curve steepening. The curve tilts like that. And you may know that when the curve does that, it's perhaps, if the curve is inverted, that's because the market thinks we're going into a recession. There's a lot of very nice microeconomics built into the shape of the curve, right? And the third one is the convexity, so these are the three main risk factors. Where are they coming from? They're coming from the following place. Let me first go back to what you did, and I'm going to give you a summarized version of what you did yesterday, which in the end 40 or 38 stocks is too many, and you have so many numbers in your screen. I have 10, and with 10 I can show you what you did yesterday in a simplified fashion. So here I have the eigenvalues and eigenvectors just as you did yesterday. And I can see that on top I have the significance. So I have the eigenvalue, which is 2 times 10 to the minus 3, very similar to yours. Very similar to yours. And the percentage that these eigenvalues explain is a little bit different from yours, because mine here is 55%. Why is mine 55% and yours was only 30%? Because I have less. You had more. When you have more, they become smaller. Right? Let's ignore that. Minus 50 yours is the same thing. 50 and 25 is the same number. Yes? We've learned that. Good. We've learned that. Okay? All right. See, 55 compared to 10. Yours was 23 compared to 5. Was 5 times bigger. Here's 5 times bigger also. Okay. So it's the same number as the one you had yesterday. And that first eigenvector is the index. Same one as you had yesterday. Your numbers were all positive, mine are all negative, but we know that this only represents direction, so you're welcome to multiply this vector by any number that you like, because the direction it represents is the same, and this is the DAX index also, just as yours was the DAX index. Yes? And this is what we call principal components. So this is what you did. Let me show you how this would work for fixed income. So for fixed income, I have the rates per day. And because every day I have a curve, I need to have 2 time variables. One is time, one is term. One I call with a lowercase t, one I call with an uppercase t. That's a time series just like the one you had. It's just that instead of having 38 stocks, I have some rates, 14 rates per day. A curve with 14 points. That gives me a time series, which I need to differentiate also. This looks weird. It's the return of a percentage. But I don't do that for financial reasons. I do that for mathematical reasons, because I need to remove the unit roots also. Same mathematical reasons why you took the simple return yesterday. You understand?
Can you fix that again?
The time series of stock prices you had yesterday, we had to move into returns. Why? There were 2 reasons. One, because returns have a financial meaning, but the more important reason is that returns will be IID. Prices are not IID, they are mean reverting. They have a unit root. These R's, there's no financial meaning to what I'm writing here. But these R's are also mean reverting. Sorry, not mean reverting. They are autoregressive. Sorry, autoregressive. They're autoregressive. They have a unit root. So I need to differentiate them to kill the unit root. I need to make them IID. This is IID. The original R is not IID. So this is the same mathematical reason. So the reason you did your returns is not because of the financial interpretation of returns, it's because of the mathematical requirement to get an IID time series. The same mathematical requirement applies to rates. I need to make the rates IID, so I need to differentiate them, which accounts to doing something that looks like the simple return or logarithmic return. It doesn't matter. Yes? Same mathematical reason as what you did yesterday in the afternoon. And then I do my variance covariance matrix just like you did. And then I get my eigenvalues and eigenvectors just like you did. It's just that in my case, the interpretation is easier than in your case. Fixed income is easier because those are the three that I just pointed out to you. The first three ones account for like 95% of the trace. The significance is very high, so I can kill the others. And the music in this case is given by the first three eigenvectors. So I have a bit rate of 3 for the fixed income market. Where stocks are more difficult, I need more. Yes? Okay. So this allows me to find the market structure of the fixed income markets. I have that. That's called the duration risk. And this is what, by the way, killed Silicon Valley Bank in 2023. That's the main risk factor, is the parallel shift. You see, all rates move at the same rate. That's the main risk factor, the one that happens 55% of the time or more, 60% of the time. And that factor killed Silicon Valley Bank. Are you familiar with Silicon Valley Bank? When the rates in the United States went from 0 to 5% in like a month, no, 3 months, 5 months, two banks collapsed. One was Silicon Valley Bank, that just went bankrupt. And the other one was rescued by UBS, that was Credit Suisse. Okay? This was the vector that killed them. Because they had bonds. And bonds, when rates go up like that, become worth less. They lose like 50% of their value. The duration is 10 years. Very bad. Then you have this one. This is the tilt, the yield curve steepening. And this killed Orange County in 1994. These are risk factors. They kill organizations. That's what they do. The convexity is a bit more difficult to understand, but it also killed, it called a Beacon Hill, a hedge fund in 2002, for example. These are well-known cases. This is what we care about. And if instead of managing stocks like Yuqing and Yan were doing, you're managing bonds, then these are the factors that you have to take into account. And you have to manage your portfolio taking these factors into account.
So credit risk. Credit risk.
Okay, we're not talking about credit risk. Credit risk is not here. This is market risk only, right? These are the market factors. Credit factors are far more complicated. Far more complicated. We don't understand them yet at this level. So I want to focus on market risk, where I can tell you about, this is the linear structure of market risk. And then I'll mention to you the, I plan to spend a little bit more time on the linear structure, and I plan to spend a little bit of time on the nonlinear, which is how machine learning comes up. So music corresponds to high explanatory power of the first components, and noise is low explanatory power. So yesterday you worked with stocks, which have high explanatory power, so a lot of music in the first principal component. And today you work with hedge funds that have low explanatory power. That's what you're doing, by the way. Your job will force you to having a portfolio like a hedge fund. You're not going to have big exposure to the index, because then you're not going to make 5%. The probability that you have 5%, if you have big exposure to the first eigenvalue, is going to be very low in your job. Your job today. You need that eigenvalue. That eigenvalue will give you the benchmark, but you have to get rid of it. That eigenvalue will minimize the probability you make the 5%. And that's why hedge funds, which is what you are, they live in the world of noise. The music is too dangerous for them. They need to remove it. They can have directionality, they can have sector biases. It's very difficult. So I want to tell you a little bit about music so you understand that. And this is Pythagoras. Have you heard of this name, Pythagoras? So you probably know him because of his theorem, right? Okay, yes, but he also did something very interesting. He used to walk to his school every day. He had the Pythagorean school, and he walked there, and he walked in front of a forge that was making these iron rods, which were hit with a hammer, and when they're hit with a hammer, they make noise, they make a sound, right? And he was intrigued. He was intrigued that the sound that came out of the forge every day was different. Sometimes it sounded good, and sometimes it didn't. So he did a little bit of research, and he found that if you have two iron rods of different lengths, P and Q, he discovered that if the fraction P over Q can be expressed with very small integers, they sound very good. But if you cannot express them with very low integers, they sound very bad. That's a very interesting observation. So from there, he actually created the Pythagorean theory of music, which still works today. And in particular, he had a very interesting number, square root of 2. Because if you take those two lengths, now you don't have to have a rod and hit it with a hammer. You can have two piano strings, one being 1.42412 times the other. And you play them together, they don't sound very good. It's not a dissonance, they don't sound very good. This cannot be written as P and Qs, where P and Q are small. You have to have very, very high P's and Q's to approximate them well. And I don't know if you know music, but this is the chord that the square root of 2 makes. Anybody knows music here? No? I'm going to play the piano for you. I'm going to play the square root of 2 for you. Have you ever heard the square root of 2? Okay, the square root of 2 is something like this. I'm going to say... That's the square root of 2. This chord developed a name in the Renaissance. You know, the Renaissance, they discovered the classics, and this was called a tritone, and was associated with the devil. And in a lot of the religious music of the Renaissance, this was the devil. Richard Wagner, many years later, he discovered one thing, one musical representation, which is every time you had a character, the character has its own melody. And this was a revolution. Now everybody does it, but he wasn't. But in the Renaissance, they already had that. If you hear this, this is the devil, okay? And it's the square root of 2, which can be very badly approximated by rational numbers. And if, on the other hand, you have a number which is like 4 divided by 5, is this one. And if you follow I don't care who you are, but you like the second chord better than the first one. All humans share that. Animals, I don't think so, but humans, we do. It's in our brain. Okay, so what is this? So this ratio between, these are the two chords that I played, okay? First is the square root of 2, and then it's 4 divided by 5. You have this in the website, you don't have to take a picture. Okay, one conveys tension, and the other one conveys joy, and this is well known. This is well known. So what does that mean in the context of what you were doing yesterday? Because this is what you did yesterday. You did this for stocks. You were doing the music of stocks. That's what you did. And I just did the music of bonds. So this is Pythagoras' theorem in dimension 2, in dimension 3. In dimension n is this, is the Fourier series. You mentioned that. Someone mentioned that yesterday. I don't know who it was. No? No. I think you mentioned that. The Fourier transform. You mentioned? Yes, exactly. So that's what that is, right? You may have seen that or not. I don't care. It doesn't matter. But every sound can be decomposed into its fundamental frequencies, which are the cosine functions. And this is how encoders of music work. You give them any sound, and they figure out a linear combination of these things that corresponds to that. Then you throw away those waves, you just keep the numbers, store them into your smartphone, and when it's time to play, you just get the numbers, multiply them through a decoder by those waves, produce the sound, and you get the sound that you digitized years ago. And that works very well for everything which is one-dimensional. These are the one-dimensional instruments for which this works very well. But if you apply this, as I mentioned, to the cheering in a live concert, it doesn't sound right because these are not made for that. The cheering has, if you have a drum, anybody plays the drum? A round drum. The eigenvalues, the eigenfunctions are Bessel functions. They don't look anything like a cosine. Okay, they're still better than when people scream and this, because then you have noise, and then the sines and cosines, they just don't do anything. But this still is used today, and there's a very interesting interpretation of that. Well, let me just go over this. I was going to talk about the Well-tempered Clavier by Johann Sebastian Bach. You know that? No, that's okay. That's okay. Let me just move. Okay. Let me just move over. Because all of this works because the wave operator, which is what creates this sound, has eigenvectors. In this case, eigenfunctions, because there is an infinite dimensional matrix, which are the sine function. In your case, the eigenvectors are the indices. You discovered them yesterday. This is how music works. And they look like that. Your eigenfunctions didn't look like that. Well, they look like that, and it's just that they were 1, and then 1s and minus 1s, and, right? We have positives and negatives. They're orthogonal to each other. So they still look like something like this, what you did for the markets yesterday. And this is part of a very general theory that is used, for example, for image compression. This is the one that you would use for image compression. That one. JPEGs. It's exactly the same theory. But instead of sines and cosines, you use that, which is better to determine the edges of your images. And you do video, and you do whatever you want. This is the way you digitize anything. Okay? There's a very interesting video I wanted to play for you. Maybe I play for you this afternoon. Okay? I'm going to go over that. It's a video by Leslie Lampert, the one who essentially discovered, well, he was the first computer scientist, as he says. He didn't know he was a computer scientist, but then he discovered that later, because computer science did not exist when he started to do math with a computer. It's a very good video. Show that later. But this is the linear theory of what how things work. Let me make an executive decision. I think I'm going to, yeah. So I'm going to now deal with I have to go back very quickly to your jobs, and I need to go very quickly to your jobs on day 5 at work. We've gone through days 1, 2, 3, you've negotiated the deal, you went on vacation, you're still working, you came back to say you were bored, right? And now I need to deal with the realities of real markets. Because we made a very important assumption when you had your job and you had your job. And the assumption was that your portfolio was Gaussian. Your portfolio is Gaussian, everything is very, very easy. You know what you need to maximize, you understand now the risk factors, we went through that. But then someone called you, or actually maybe you went back from your vacation because you saw a graph like that. You said, oh my God, this is not going to work. Because this is just some histogram of returns, and you see this does not look Gaussian at all. It doesn't matter what this is, it's not relevant. Okay? But sometimes markets are just not Gaussian, and if they're not Gaussian, then the argument that led us to pick the optimal portfolio will break down, right? And my God, what do we do? So let me tell you what people do. Okay, things are not Gaussian. So when things are not Gaussian, what do you do? There's many different things that people do, and they're all voodoo magic. Hardly any one of them works. But I want you to understand that there's voodoo magic out there. People do voodoo. Do you know voodoo? Okay, that's what people do. So I'm gonna go through a few minutes of voodoo, and then I'll do the math. Let me do the voodoo. One thing people do is they do moving windows, which we saw earlier, right? You just move the window around and say, oh, it looks like that. That's voodoo. The other thing that they do is exponentially weighted moving averages. That's voodoo, big time voodoo. But it looks like math because there are so many formulas on exponent. You know what I'm talking about, exponentially? Maybe you have used them yourselves, right? Yes? You have used them yourselves? It's voodoo. There's nothing in heaven for those sums. The exponentially weighted moving averages, they have nothing in heaven. Oh, do you know that? You know that. There's nothing in heaven. They're not an estimator for anything. You say, well, this thing happened a long time ago. Well, I should almost ignore it. So I'll multiply by a small number. But there's nothing, there's no probability theory anywhere that justifies the use of exponentially weighted moving averages. For me, it's the biggest voodoo that exists. But everybody does it. But there's no math. What? Sir? Am I offending someone?
We're working on a project where we use that all the time.
Look, I'm a very practical person. You should be very practical. This is what I tell my students, okay? And I'm telling you. There's a very high probability, not forget universities, at work. They will ask you to do that. You smile and say, yes, I'll do it in 5 minutes. And you do it. Just be aware you're doing voodoo. It means nothing. Okay? But people love it. Because they know no better. When you're in the university, I suspect your professor that you do probably knows a lot. But not about this. Voodoo. Okay? But do it. Sure, get a good mark. Be very, very pragmatic. And you go to work, get your bonus. Do the exponentially weighted moving averages, get your bonus. But then, when you go out of work, you vomit. Very peacefully. Voodoo. You understand why it's voodoo? Well, okay, I don't have time. I didn't want to waste my time with that. It's just voodoo, okay? I don't want to waste my time with that. I don't want to waste your time with that. Then we have ARMA models. ARMA models, they're not voodoo. They're wonderful models. They work all the time and they're great. And they're like the Gaussian. They are very nice, idealized situations of why things work. And then you have GARCH, the ultimate complexity, trying to understand things which are so complicated. And they work, but they are so hard, no one uses them anymore. They were a big deal in the 80s and the 90s because it was the right way to deal mathematically with all the weird things that are happening in the markets. But they're very hard to work with. It was easier to work with exponentially weighted moving averages. So people replace solid math for voodoo, which everybody understands. Oh, and by the way, Excel does it for you, whereas Excel does not do GARCH for you. GARCH has things in heaven and earth, but they are so hard. So hard. You need the high priests to manage them, right? What? Okay, I'm not going to the copula. In fact, I was not planning to talk about the copula today. I'll talk about the copula some other time. Okay? Copulas are good, but not for what people think. They're good for other things. This is my favorite. This is my favorite voodoo. This is the semi-standard deviation. Maybe you use it too. This is required knowledge. If you do the CFA, if anybody of you does the CFA, this is required knowledge for the CFA. And I tell the students always the same thing. I say, sure. And I'll tell you the tricks that you have to use for that. And this is how it works. This is perhaps the most interesting, or the second most interesting observation I will make today. I will explain to you why people have created this voodoo, and I will tell you why it doesn't work. Very clearly. So, why did people do this? Well, people did this because they do not understand the standard deviation. And because they don't, I mean, just like they don't understand the average return, what would you expect them to understand the standard deviation? If they don't understand the average return, you give them a 25% average multi-return and they're happy until they lose their money, right? But the same people don't understand standard deviation. And they think standard deviation is wicked, bad, evil. Because in standard deviation, they say, if I have a very good performance, very good month, it increases my standard deviation. And they think standard deviation is risk, it should only contain the bad things. Yes? Well, that's not understanding the standard deviation. The standard deviation doesn't give you anything bad, it just tells you what it is. It's that, it's not this other thing, right? So they say, oh, I'm going to create the right standard deviation. It's called the semi-standard deviation, in which what I do is the following. I'll explain. A lot of variables there. So let me go step by step. I look at every monthly return, RI, like always, and then I pick a benchmark. Usually they pick 0. They don't have a lot of imagination. I hope I'm not insulting anybody, sorry, okay? They don't have a lot of imagination. They say, well, I'll pick a benchmark, say 0. So you pick a benchmark, R star, and that's 0. Or any other number. So if my monthly return is bad, is negative, yes, I keep that number. But if it's good, I throw it away. It should not contaminate my bad risk measure. So I only keep the numbers where I am below the benchmark. And I see by how much I'm below the benchmark, right? I'm okay so far. So if you want to see the days that you're below the benchmark, yeah, that makes sense. I can see something in heaven that looks like that, right? That's okay. And then they say, I'm going to take that number, I want to square it. Why would you square it? Oh, because the standard deviation is squared. Well, the standard deviation is squared for a very precise reason, because I want to look like heaven. But what in heaven looks like this? Oh, you want to look like in heaven, but to the right. But that's not what we're doing. Voodoo. Right? And then, this is the funny part. Well, then you sum all of them. That's great. And then here's the funny part. You divide by 1 over n minus 1. You could divide by n. Say, no, n minus 1. Why? I don't know. In the standard deviation is n. You know that sometimes the standard deviation, if it's the population one, is n minus 1. If it's the sample one, is n, right? But here there's no population, there's no sample, there's nothing in heaven, so you're just doing something that looks like something else. When you're trying to do something which is different from that something else. Voodoo. But then, this is the funny part. They don't agree what that n should be. There's in fact 2 definitions out there for what n should be. And n could be 2 things. N could be the number of all months or the number of months when I lose money. Right? Both make sense, and when you're making your voodoo needles, you say, well, I can do it like this or I can do it like that. I don't know. And some people say one, some people say the other. And of course, this is what happens when you're creating something which is not in heaven. You have nothing to look at. And you don't know what this has to converge to. Right? So I think if you're doing the CFA, I said, review this and give the right answer, whatever it is that they ask you. But I think in the CFA, the n is the number of months which are negative. I think so, yes. Which is very interesting, because if n is the number of months which are negative, if I have a fund, an investment that loses money twice, because I have the n minus 1. Okay, if I have an investment that loses money twice, it has a very high standard deviation, semi-standard deviation. It made money every day for the last 25 years, but it lost money twice. The semi-standard deviation is very bad. What kind of a risk measure is that? You understand what I'm saying? Voodoo. But then these other people say, no, you have to divide by all the months. Okay, fine. It's perhaps slightly better, but neither of them, it breaks the basic premise I told you at the beginning of class today. On earth as it is in heaven. And when you don't have that, when you don't have the probability or the math telling you what to aim for, these things are just Excel add-ins. That's all they are. You'll have to use them. The probability you have to use this at some point in your life is very high. So in that case, just use them, but be aware that is voodoo. So when you're finished, wash your hands. You get what I'm saying? Okay, I don't want to offend anybody. Nothing is far from my objective. Nothing in heaven. Just be aware. And whenever you do something, say, what's this formula coming from? Always look for the heavenly version. And that will give you a hint of when it works, when it doesn't work, what the meaning of 25% is. Because that's all in heaven. That's where you learn math. You don't learn math so that you go use Excel and get whatever number Excel gives you. You understand what I'm saying? Okay. Sortino ratio, that's my second favorite. Because then, say, well, I look at the sub-ratio and then, well, I don't like the standard deviation, so I replace that by the semi-standard deviation. Sure. Voodoo again. In our sub-ratio, we know why we want the sub-ratio. You discovered that at work on your first day. I don't know of a single employment contract where you optimize your pay with a Sortino ratio. In fact, what is written in the this is not Sortino, someone else, is actually wrong, because they say that the standard deviation of negative asset returns, that's not true. That is actually not true. The standard deviation on negative asset returns is this. And this is in heaven, by the way. But that's not what the Sortino ratio is. Okay? Now, let me continue, and I think I want to do something about AI. I don't know what I will do. I think I've given you a lot of material this morning. I think so. Yeah, I think so. Okay, so let me talk about moments. That's another thing that is used. And this is my all-time favorite. So moments have, you know what moments are, yeah, right? First moment, second moment is standard deviation, third moment, fourth moment. And people in finance, they use the third and the fourth moments, the skewness and the kurtosis. They're nice things. They work like the first and the second. Good things for simple minds, because they give you a number. This is not voodoo, by the way. This is not voodoo. This is very, very difficult math. It's the opposite of voodoo. And the math is so hard that everybody misuses it, as I'm about to show you. Okay? So the first is the skewness. The skewness is this. People take the central third moment, which has perfect heavenly versions, perfect earthly versions, perfect estimators. That's the estimator. It's unbiased. It's good. Instead of 1 over n, it's n over n minus 1 times n minus 2. Morally like 1 over n, but it's the right estimator that heaven tells you should use. Wonderful. It measures whether my distribution is skewed to the right or to the left. Because you can see that if I am very much to the right of the mean, when I take that to the power 3, that's a big power, it makes it very heavy. Yes? With a positive number. And if I'm very much to the left of the mean, when I take the third power, it's very heavy, gives me something very negative. So it measures my imbalance with respect to the mean. This is true. This is documented. It's in heaven. In the heaven of mathematicians, you know what I mean, right? It's good. The kurtosis is something similar. It's the fourth moment. It's in heaven also. I have the estimators right here. Good estimators. Theorems tell me that this converges to heaven. All great. They measure how fat my tails are. What?
It's a Fisher kurtosis, right?
What?
Is that a Fisher kurtosis?
It's,
You subtract like 3. Is that?
that's 3. That's the number 3.
Yes. Is that the Fisher kurtosis that you just?
Oh, okay. Yeah. So yes. What did you call it? The
Fisher kurtosis.
I don't know what that is. It's the fourth moment you subtract the number 3 because for the Gaussian that will be 3.
Yes,
So it's the excess kurtosis. Yes, exactly. Thank you for that. Thank you. Yes, I forgot to say that. Yes, exactly. Right. Okay. And this has earthly versions that Excel will do for you and has heavenly versions which are in heaven. So we know we're doing the right thing. Now, this does not stop us from being aware that these quantities are very, very hard to deal with. And they give rise to a lot of computational errors. That's the problem with these things. They give rise to a lot of computational errors. The easiest way to explain that is as follows. Let's look at these sums. Everybody who has done programming with care will know. When you look at the sum, oh, by the way, maybe you're using the student sum kurtosis. I'm sure you are. Academics love it. But very few stop to think what they actually mean. Sad for academics, right? You think the academics who have nothing to do, they would just think. Sorry, I'm one of them. I'm very busy. I have a lot of things to do. Okay. But note what happens if I have a sum of something to the power 3 and a sum of something to the power 4. I'll give you a very simple calculation. Let's say that I have one outlier, which is 10 times bigger than the rest. This is not unheard of. 10 times bigger? Yeah, you have them. If one outlier is 10 times bigger than the rest, let's just think computationally. What happens to that sum? That one term is 10 to the power 3 times bigger than the rest. And the kurtosis is even worse, it's 10 to the power 4 bigger than the rest. What does that mean? In most, how many samples did you have in your time series yesterday? About 1,000? 1,000, right? That means that one term is as big as all the others. So people think they're doing statistics because the summation sign is there. But no, that sum is dominated by one event. One. So it's not that it should not be used, it's that you should know what you're dealing with. It's like the 25%. You just need to understand what that number means. And very often the number that the students give you is useless. Not always, but often. And this remained one of my best experiences as a teacher anywhere. I was saying more or less this to no less than 60 people from a big bank who came to listen to me. Actually, they brought me to lecture them on different things. And when I said this, it was like almost a mutiny. People started to throw the papers up in the air, they started to scream. They told me, we had someone here yesterday, consultant came from London. Consultant from London, guaranteed, know nothing. And told us that these are the only two things we should use. Only use the skewness and the kurtosis. Of course, it was around the year 2000 when all of this were mushrooming. Everybody was coming up with their next voodoo. People had computers, so they discovered voodoo on their own, right? Oh, I've tested this thing that I just made up and it works great. Everybody, in the year 2000, this is what was happening. And that's the problem of everybody having their own computer. There was no Facebook at the time, so people always like to screw themselves with computers, right? So before Facebook, what they did is they did mathematical formulas. That's what they did. So they said, I didn't say that you should never use them. I'm just trying to alert you that they have a very big problem. And then one person in the audience, he was in the section of the bank whose job is to think. That's all they do, and they write papers. He said, rose his hand. I said, he had written a paper. I didn't think of that, but it was wonderful. He did the Markovitch theory with the skewness and the kurtosis. See what happens. And he discovered that if you do the Markovitch theory with the skewness and the kurtosis, the optimal portfolio is the one that has the best performance on the worst day. I said, of course, there is no better way of expressing what I'm trying to convey. And it's true. If you use this and you optimize, because the worst day is going to be your biggest outlier, worst days are bigger than best days. We know that. Markets are asymmetric in that sense. And you optimize to that. Of course, what do you optimize to? To the only event that matters in your so-called sum. And yes, the result is that you have the best portfolio in the worst day. How optimal is that? Right? So this is another thing I want you to be aware of. Another voodoo aspect. This is how the skewness and this is how the kurtosis looks when you look at them over time. There's really no information there. And now to end this discussion, I want to present to you a caricature, my announced caricature of a presentation I had to endure once. Someone was trying to convince, not just me, a group of us, that their investment was good. And they did it using statistics. There was a very efficient salesperson who came to us to tell us about a certain investment. And the conversation was something like this. So I have here, I've hidden the fund performance from you. I'll show you at the end. This is the performance of something I reconstructed, not his original fund, which I would never do. Okay, but the story went like something like this. And I think by now, a lot of these things will ring some alarms in your mind. At least they should, if you've paid attention to class today. The presentation went something like this. I said, oh, my fund is fantastic. It produces an average of 7% per month. Now, after today, you're not impressed by that, right? What's your next question? Where's the volatility? And actually, someone in the audience said, hey, wait. But I see there that your volatility is very high. It was on the screen. I said here is 60%. Okay. But by the way, before I give you the answer that the salesperson gave, what is your estimate whether this fund is making money or not? Before I continue.
No.
No what?
Not making money.
It's not making money. Give me an idea how much money is losing. You can do that. Give me an idea how much money is losing. Using Ito's lemma, of course, but I know that Ito's lemma, I mean, it's just an approximation. It's just some heuristic. You should be fast at this. Come on. 60 squared is 36. Divided by 2 is 18. Minus 7, 12. So I would expect that this loses 12% per month on average. So after a year, I'm probably bankrupt. That's my guess. I don't know. I haven't disclosed the fund to you, but I've taught you some back of the envelope calculations. I showed you some intuition to think about that. I expect this fund to be bankrupt just because of those two numbers, right? Okay, but the person was asked, I said, but the volatility is very high. She said, oh yes, the volatility is very high because our manager is so good that every time he makes money, he makes so much money that the volatility is very high, but as you all know, the volatility is terrible. I have to report it because the regulators say I have to report it, but it's really, look at my skewness. 30% per month is huge. That means, as I told you, it's statistical proof that what I told you is true. When we deviate from the mean, is to make a lot of money for our investors. Voodoo. But this is, look, the skewness is in heaven. We can see it is the third central moment. There's nothing wrong with that. But implementation is extremely difficult. And when you mix it with accounting, deadly. Deadly. Good average return, very high volatility, but wonderful positive skew. And by the way, I cooked my example so that the skew is, so that the kurtosis is practically nothing. So not to say there's something weird going on in the tails. No, I don't need that. That's my investment. This investment has 7% average return per month, very high volatility, and very positive skew. I know you're not surprised by that now. This is what I think you've learned today. What's the best month? That one. 300% return. You're from near death to less near death. You went from 10 cents to 30 cents. That gives you a 30% return. By the way, that month makes the skewness positive. It's the only one that makes the skewness positive. If it wasn't for that, the skewness would be very, very negative. This is the power of math. That you have a nonsense detector and know when something makes sense and something does not make sense. Okay? So what's the summary of what I've told you today? Believe nothing. It's the best advice I can give you. I'm a mathematician. I could be here to tell you, oh, math is good for this, math is good for that. Yes, it's good for that, but it's so hard to use math in an efficient way in a financial market and investment framework. It's very hard. And just be very aware that math, like health, is difficult. And voodoo medicine, I don't know if it works, but there's nothing in heaven. I don't have the science of why it works, right? But even with the science, you have to be careful because many hidden factors, many things that you don't know, you have to move with a lot of caution. Okay. All right. I'm going to end with a very fast discussion on machine learning, which, by the way, there's a lot of voodoo there, but at least the voodoo is done by machines, not by humans. And machines are better at voodoo than humans. Humans are... And I want to show you, just to share 10 minutes, and then we go for lunch, just to share with you how machine learning is disrupting a lot of what I'm telling you now. And I want to do it not in general, just to focus on one example. Let's say that I have some data that links volatility and company size. This is what we call the features. And if the relationship in my database is this, there's no way I can make any linear relationship between this. It just, there's nothing. So I can resort to voodoo or I can resort to machine learning. So machine learning is, I could do this in different features. I could say, what's the relationship between stock returns and interest rates? Also nonlinear. Everything we've done today was linear, everything. Okay. If you want nonlinear, that's really hard, and for that we need to use computers. So the way machine learning does it is to say, well, I'm going to do a decomposition. I'm going to just try to group things so that they look more or less consistent with each other. And in this case, I'm going to explain to you how regression trees are done, which you probably already know. But I want to present them to you as an alternative to everything else we discussed today. And regression trees are obtained by compressing information, not using MP3s like we did earlier, and Pythagorean music, but by using a way to break up your huge database into things that are coherent with each other. And the coherence is measured with the residual sum of squares. So I'm going to replace a data point by a simplified version of itself, which is going to be the center of that rectangle called by x hat. And I want to pick these rectangles in such a way that they group the data very efficiently together. That's all I am doing. And this will help me understand the nonlinear factorization of financial markets and understand what causes what. So at least what happens at the same time, what explains what more than anything, okay? So for that, I'm going to use training observations that will help me create my classification. And then with this classification, I assume it works everywhere. So I'm just going to walk around with my classification rectangles and say, this is how I'll understand whatever data you give to me. That's what machine learning is, okay? So how do you do that? So in this particular case, they say there's always an algorithm. That's where computers work. And in this case, the algorithm is a very simple recursive split. No neural networks, no transformers, no need for that. This is simpler than that. And I want to use this to explain the alternative to what I mentioned today. So for every pair of a feature and a value of that feature, what you do, you break up your data set into two hyperplanes. The one to the right and the one to the left of that particular feature. And you do this for all possible features in all possible values. So already computationally very, very time consuming. But computers are fast these days, that's why these things work. And you compute the residual sum of squares if you simplify your data set with the centers of the resulting rectangles. And then you pick the feature end value of that feature that minimizes that residual sum of squares. So the result will be a certain feature, a certain value, I have it there. And then with what's left, you do the same thing all over again. This is a recursive algorithm, and then you have the second split and the third split and so on and so forth. That's great. Now, what's the problem with this? The problem with this is that you don't know when to stop. The computer will always say, oh, let me do another one and I can improve your residual sum of squares even more. I said, okay, go ahead and do it. But in the end, the computer is going to take as many rectangles as you have points in your database, and then the residual sum of squares is 0. So, oh, brilliant. So now what? You told me that the data is represented by rectangle and each data has its own rectangle. That doesn't work. So you have to figure out a way to stop, right? And not overfit the data, because this leads to overfitting. And the way to do that is by imposing a way so that your trees, so your process is not too refined. And you do that by attaching a cost to each branch. So every time you're going to do a new recursive split, you're going to charge your algorithm a certain amount of money or a certain amount of currency, whatever the currency is. And you do that by modifying the residual sum of squares with some cost associated to the number of splits that you do, or the number of branches in your random forest. This gives rise to a random forest. The thing is that you don't know what that cost should be, but for every cost that you have a different tree. If the cost is very high, you have a tree with very few branches. If the cost is very low, you have a tree with a lot of branches. What is the right cost? You don't know. You don't know. So for that, what I'm going to do is I'm going to use an additional data set, which I call the testing data set, which I will use to determine what that cost should be. So now we have two sets of data sets, right? Two sets of data sets. I have a data set for the training, which are the trees, but the other one is to fix some other parameters, like in this case, the cost of a branch. And this is the process that's called cross-validation. I can do this. So you give me the entire data set, I'm going to break it up into some groups, and in this case, I broke it up into groups of 4. And there I use 3 for the training. Training is always more difficult. I want big training data sets. So I use 3 for the training, 1 for the validation. So I calculate the optimal cost in the 4th one. And I do this for all the possible combinations, and I hope that after I do that, not only I learn how to map my data with those trees, but the trees will be optimal enough. I've determined what the optimal cost should be, so I don't overfit, but I don't underfit. Okay? It's an algorithm. Like this, there's millions of algorithms. And they work if you can make them work. Okay, so there's many different versions of that. And I think you've seen that. I just going to. So at the end of the day, this is something which allows you to test data which is numerical. And you can extend this to data which is not numerical, data which is 0 ones, you know, the typical example of distinguishing between cats and dogs, which is, you know, that's what the ultimate objective of every image recognition software, right? So in that case, you do something very similar. You replace the real value that we had earlier by a yes or no by a Boolean variable, true, false, 1 or 1, okay? And instead of the residual sum of squares, we end up with a classification Boolean variable, which is either 1 or 0, leading to an error rate, which is between 1 and 0. And there's 3 objective functions to do that. I don't know if you know that. This is not so interesting. One is the error rate, which is the maximum value of the error, which is not sensitive for a tree growing. The other one is the Gini index, and the last, which measures gives you a good measure of variance of knot purity, and the last one is the entropy, which is the one that is somehow most efficient. So, all right, so I think I'm done with that. It's exactly 12. So I think, I don't know if you have any questions, but at this point, it's safe to break for lunch. Yes?